Financial risk in business. Okay, that's not clear enough. That means I'm not really communicating clearly. Can somebody else help me to be very sure that my communication is clear enough? What the definition that I'm giving as regards financial risk in business is a layman definition. I don't want to complicate it for us, so that's why I'm giving a layman definition. So I want somebody else to help me again, based on the definition that I've given. Like I told you, I'm not using any notes, so I'm just giving you based on the layman experience as a financial person myself. So I want somebody to also recap what I've said. I just want to be sure that we are all together. What is financial risk in layman definition, as I have just explained? Okay. Okay. Yeah, you have tried, but it's not encompassing him as much as I've said it. Yeah, but you've tried. I said any risk related to money or anything that relates to money, whereby the risk that attach to any sources where money come from or anything that you use money on. That is, when you spend your money on a particular activities in your business, or money is coming from a particular activities in your business, any risk attached to that thing, they are financial risk. The risk may be that the money will not come. The risk may be that when you spend that money, it may be wasted. So that was why I said what the two contributors said now is not out of point, but just that is not detailed enough. So it encompasses both the usage and the sources of money, risk that are attached to them. And let me quickly explain that again. When you spend money on, let's say we buy a machine now, we wanted to invest in automation of our process, we buy automated machine, and we are projecting that with this automated machine, we are spending maybe 10 million naira on this automated machine, and we believe that it will produce 1,000 per day, and while normally we are producing maybe 500 pieces per day, but we wanted this machine to produce 1,000 pieces per day. When we spend that money, there is a risk that after spending that large sum of money, we would not even do 100 pieces per day. That is a financial risk of spending that money, of acquiring that machine. But financial benefit will be if we spend that money and we are now producing 1,000 pieces or 1,500 pieces higher than what we were doing before, then there is a gain for spending that money. So that is a simple explanation of a financial risk, and all of you can understand that there is a big financial risk that we incurred some times ago. And also, I wanted to say that on the issue of sourcing for money, what the basic source of money is your revenue from sales, revenue from services, consultancy services, depending on the service we render. So there is a financial risk if there is the possibility that that money that we are sourcing as revenue will not come. When a company could not make revenue from sales or its primary activities, then that is a big financial risk. Are we together? So I'm just trying to be very crude in this explanation, because if I want to start explaining it from the financial perspective, you may get it mixed up, and that's why I don't want to use any financial jargon. I don't want to use any financial jargon, which means financial terminologies. So now, how do we then identify financial risk? I have already said that when the money that you are expecting is not coming in terms of inflow, there is a risk. And when the money you are spending is not bringing the benefit that you are expecting, which is in terms of your outflows, then there is also a risk. So from all of this that I've said, how do you identify financial risk in your business? Number one, market risk. I have already said that when the money you are expecting is not coming, that is a big risk for your business, and it's always about the market risk. So the market risk involves the possibility that there will be fluctuation in the market for any reasons. There could be fluctuation in the market for any reason, such as season, such as maybe there is hot weather, like in our own case, when the hot weather is hot, there is always a fluctuation in the market, whereby the number of people that will be using butter as cream will reduce, and likelihood goes to lotion and more of bathing with soap. So that is an example of market risks, a simple example of market risks. Market risks are just things that are not really, that would make your financial to be dropping. And it could also involve interest risk. If the interest, maybe you are running your business with loan and the interest you are getting for that loan is higher, then that is also a big risk to you, and they attribute it to financial risk. Another market related risk, which is more like an industrial risk or industry risk, is government exchange rate, or whatever activities that is happening in your industry, such as take for example the okay, I will put that under operational risk. I wanted to talk about the scarcity of share note, but I will put that under operational risk. So all of these are financial risk, but in their own subheadings. The second type of financial risk is credit risk. Credit risk. Credit risk is, are we together, please? Please, if I'm complicating it or it's not clear, take note and ask question. I don't want to spend more than 7 minutes more. Okay, so the second type of financial risk is credit risk. Credit risk is also going to affect money that comes in. Like the one I explained earlier, market risk is also going to affect the money that comes into the company. Because if there is a fluctuation in the market, people are not buying as much as expected as a result of any reason, season, whatever, then it's going to affect the money that comes into the company, which is a financial risk. The second is credit risk. This is when your customers that you have given out loan to are defaulting. Not when I say loan, I'm not saying we are a bank, but maybe you gave out a credit facility, depending on your type of service. We call them debtors in business. So in your balance sheet, they call them debtors. There is debtors, there are creditors, so which are also called current assets. So for those of you that studied accounting, so whenever your credit, which is an option of your current asset, refuse to pay, that's when your debtors, those that are owing us money, they refuse to pay us. That is a big financial risk, because it will reduce the number of money that comes in. No, I've already said it in my definition. Financial risk is when those money that is supposed to come in are not coming in, and when those money that is going out are going out and they are being wasted, or they are not delivering the expected result. So when your debtors refuse to pay is a big financial risk. Imagine presently in Amugold, I won't be able to mention the figure now. If our number of debtors that we have is at what we have now, is a big financial risk, because the amount people are owing us presently, if we want to go to a bank to borrow such money, is not likely going to be easy, and is also going to come with interest. Presently, banks are charging about 25 to 30, and I learned that is even going to 40% per annum on a loan. So what that implies is that if those money we are keeping outside, I believe the accountant is listening to this, if those money that we are keeping outside with our customers continue to stay with them, and I will give Mrs. Adeoye an assignment on this, you need to go and calculate what money we have outside and the percentage, per annum percentage. If we had borrowed that money from a bank, how much are we going to pay back? Just use a simple interest rate. There is compound interest rate, there is simple interest rate. I will find another time to teach us that one, how to calculate compound or simple interest rate on a loan. There is reducing balance, and there is a straight method as well. I will not go deep into that now, but I want you all to know that if you are working in Amugold, you cannot work in Amugold and be an empty brain person. You must fill up your brain as much as we do our work. So Amugold is like a small school. Amugold is like a small business school. So when you are a staff of Amugold, we want you to be an intrapreneur, hence salary and make money from your own business as well. And that is why we are wasting, not a waste of time anyway, but we are spending this time to teach you all of these small financial educations. So what am I saying in essence? Mrs. Adeoye, the assignment for you is look at the present amount they are owing us, and look at it that if look at the average, know that that's almost the average. It goes up, comes down, goes up, comes down. So if we continue to hold this figure outside for a whole year, and we are to borrow at 30% interest rate presently from a commercial bank in Nigeria, which some banks are even giving out more than that, how much do you think we will have paid that bank extra? That is a big financial risk. It means that we are losing money when we keep our money for so long with our debtors. And that is why we should not for any reason take outstanding debt for granted. We should keep pursuing them as much as we are pursuing new sales. It is easy for marketers to go to the market and pursue a new client, but it is also a bad thing for the customer to for the company to sell to that customer and not collect the money, because we deprive ourselves the opportunity to buy additional raw material and also produce more and make more profit. So we are losing in two ways. We are losing profit, and we are also losing in terms of interest, because we are not charging those people for the use of our money. There is what we call cost of capital. So this is a big risk on a company, and we should never take it for granted. The third type of financial risk, I'm rushing this topic because I don't want to waste much time, is something that I should be explaining under gentility, but I want to be very aggressive to explain it to us, because it is something that can take a whole month if I need to start talking it slowly. So the next type of financial risk, I've talked about market, I've talked about credit, and the next type is, and under credit as well. Credit that I just explained now is from the perspective of when you give out money and the money is not coming back. That is your debtor. There is another credit risk when it involves your inability to raise loan, your inability to attract credit. You know that credit can be a credit that you have been given out, which is debtor, or a credit that you have been given, which is creditor. So when somebody gives you credit, maybe supply us on credit, or gives us loan to do our business, that is an inflow credit. But when you give out goods on credit to your customer and they are to pay back later, that is an outflow credit. So when the company is now unable to attract external credit, nobody is ready to sell to us on credit. Ẹ má tajà fún wọn láwìn, amúgòd wọn ní sanwó, lè gbọ́jà fún yín láwìn, tẹ́ bá ti fún wa lówó àní fún yín lọ́jà, lè yá yín lówó, tá bá yá yín lówó pẹ̀lú gbogbo nǹkan tá a rí nísìn o, ní asset tó lè stand the collateral as security for that loan. Tó bá ti ń di level yẹn, there is a credit risk on that business. That is, the business is not attractive to external funding. It's also a big credit risk in terms of inflow. And it's a big credit risk. If you give out money to customer or goods to customer and they are not paying back, it means that some of them have diverted your money. Wọ́n lè ti tajà yẹn kán fi fẹ́ yàwó kejì, or kán tajà yín kán fi máa ṣe another business. So it's also a big risk on that company. The third one is liquidity risk. Liquidity risk is there is what we call liquidity ratio in business. Liquidity ratio is the ratio of your liquid capital to non-liquid capital. A liquid capital is the money that is cash in hand or cash at bank, or the easiest to change to capital and to cash. What am I saying in essence? If we have our money as raw material, take for example, all our money, our current asset is raw shea butter. Raw shea butter is a current asset, is liquid, but it is not as liquid as the money in the bank, because raw shea butter has to go through processes, will be packaged, we fill it in the jar, we put the label, then it becomes a finished product. So finished product is a liquid asset, but is more liquid than raw material because it is almost ready to sell. So when we now have finished product in our stock, is as good as a liquid asset. Well, that is, if the company needs money urgently, we can quickly tell Mrs. Adewale, oh yeah, release àwọn ọjà tó wà ní store, kí àwọn customers sanwó wọlé, make sure pé ẹ má ta láwìn o, ẹ tà ní cash because I need the owó. It is liquid because we can quickly sell it and get money back. The other type that is very liquid is the one that we have sold. Owó yẹn ti wà ní bank. So there is liquid money in the bank. So this is a simple way to explain liquidity in finances. And what does that entail? If a company has more money in their bank, liquid money in the bank, they can quickly meet expenditures. Bọ́n ṣe ní àfẹ́sáré ra ilé wọn kàn ní ó yá ẹlò access bank, àfẹ́sáré ra ilé ẹlò GTB, àfẹ́sáré ra ilé ẹwòye tó wà ń bí extended sí customer yẹn. So that means the company is very liquid to meet any need that occurs immediately. However, if your business is also too liquid, is a big risk on you. What that means is that you are keeping too liquid money, which implies that you have money in the bank, but maybe you are supposed to use those money to have procure raw material. So when you keep your money too liquid, you will be losing money from the profit you are supposed to make if you had used that money to buy raw material, produce, sell, change it to cash, and recycle it like that and like that and like that. Am I confusing or convincing you? So it is good to keep liquid money so that when liquid operational expenses comes like avesari belt, avesari repair machine, avesari diesel, we can have money to do it. But don't keep too much liquid money, because at the expense of raw materials that you are using for production, what is the essence of millions of naira in your bank account and there is no raw material to do your business? So that is is a big financial risk for your business. So as a business owner, you must know when you should stop keeping additional liquid money and start pushing them to raw material. And that's why sometimes you will just notice that plastic are coming into the factory, whether you need it or not. We keep bringing all those things in because it is better we keep them in material form than in liquid form. Another risk with liquidity is that when you keep your money too liquid, it gets affected by value of money. And there is what we call time value of money in finance. But I can stop by. Because bí mo ṣe ń sọ lọ gan ó kàn ń wá sí ni as if pé mo wà nínú class. Okay, so let me quickly see how I can summarize it, because I still have operational and regulatory. But I will see how I can just summarize it. Then maybe tomorrow I will continue with it, because I'm just wondering if I had prepared for this topic, how it will look like. But one good thing is anything finance, I'm always ready. So and that's why it's coming this way. However, I'm just still talking on liquidity risk. So what I wanted to say is that don't be too liquid than don't be unliquid. What it means is that don't use all your money to buy raw material at the expense that when you now need some operational expenses, you are now unable to meet those needs, because it could also be a big risk. Imagine if you had used all our money to buy raw material, packaging material, and then we now need money to buy diesel to operate that machine on that, and there is no more money to buy diesel. It means that that company is under a big financial risk, because we can no longer buy diesel for our operation just because we have bought so many raw material. So financial management, financial control is a very big task, and that is why you see that sometimes when you ask for expenses, we say, okay, let it go through the finance or account department. The reason is that we want to use it to balance our financial liquidity, so that we will not just be pumping money to some things, and also be careful with how money goes out and achieve the result that we expected. The next one that is still under liquidity, actually, liquidity, another liquid money that is not like cash is the money that people are owing us. That one too is liquid, but it's not as liquid as cash. But money that they are owing us is more liquid than finished product, because sometimes we want to sell finished product and we will not be able to sell it. However, we can quickly call on a distributor and say, if that person has a good credit worthiness, he can quickly pay. That will not involve us transporting the goods, sending it to a customer, and then they pay. So there are different levels of liquidity. Then another thing is that there is what we call liquidity ratio in business. Liquidity ratio means that you measure how much money, how quick can you turn your current asset to meet your current liability. That means that if we are owing people 10 million and we have current assets of maybe goods in our store, and people that are owing us, we have goods of 8 million and they are owing us 4 million, which is 12 million. So our liquidity ratio is the comparison of our current asset with our current liability. Ó túmọ̀ sí wípé how far la lè sáré ta àwọn current asset wa ká fi lè san current liability wa àwọn tá a jẹ lówó. If your company cannot have 2.1 ratio, there is a big financial risk in you. That is, your current asset must always double your current liability. Ìtumọ̀ ẹ̀ ni wípé tẹ́ bá ní àwọn èèyàn tó ń jẹ wá ní tá à ń jẹ ní 1 million, a gbọ́dọ̀ ní àwọn nǹkan tí finished product wa àtàwọn tó ń jẹ wá lówó ó gbọ́dọ̀ tó 2 million. Tí ò bá ti pé 2:1, there is a risk on your business. Ìtumọ̀ ẹ̀ ni wípé táwọn tí ó ń jẹ wá lówó bá kọ̀ tí wọ́n sanwó, àwa náà ò ní lè sanwó padà fáwọn tá a jẹ lówó. So every company ó gbọ́dọ̀ máa ní double owó tá a jẹyàn, so that tí kan nu àwọn tó jẹ wá lówó ò bá jẹ sanwó, a lè sáré fi èyí tó kù, apá kejì tó kù ká fi sanwó fáwọn tá a jẹ lówó, so that credit reputation wa kò ní wà affected. Operational risk ó ní túmọ̀ sí wípé a kàn ń náwó sórí àwọn nǹkan operation kò dẹ̀ fún wa ní result. It also brings it's also a financial risk. I deliberately did not explain all these things because I want all of you to be talking about different kind of risks in your department before we can now harmonize it into a single financial risk. So look at it now that à ń náwó sí machine, à ń náwó sí equipment, à ń náwó sí gbogbo nǹkan, à ń náwó sí salary, à ń náwó sí everything, but kò yọ lára nǹkan tí company make as sales. That is a big operational risk which affect the money that company is making, and the money that we are spending is also not bringing good results. I will stop at this point and I will seek for question. There is a way to manage financial risk, but I will look for another time to discuss that. But one of that way of managing financial risk is what I explained to us yesterday, which is diversification. So it helps you to increase your income flow and the likes and the likes. But like I said, I will explain more to you how you can manage all of these financial risks that I just explained now. Thank you everyone for your attention, and now it's time for question and answer. I didn't get you. Yeah. I didn't get you. Is it what? Okay.
Sorry, sir, before you answer that question.
Okay. Sorry, let me take note of that question from Mr. Jacob, because I think they are triplet question, I guess. So he talked about bad debt. He talked about I think he's done with the galloping diversification, Abi. That's clear. He talked about bad debt. He talked about someone that died, which is also like, how do you manage that? And it also talked about at what point to stop giving credit. Is that correct? Okay, so the next one, please.
So I want to ask about the credit limit, like giving out credit to your customers. So as marketers, we discovered that one of the challenges we're having as a company with our other competitors at this aspect of giving out credit. Now, is it advisable that we give our goods on credit limits? And if we are doing it, at what percentage should we do that so that it will not affect? Thank you, sir.
Okay. So thank you very much. The questions are very interwoven, so they're intertwined. But I will try and pick it one after the other. So like I said yesterday, someone saying something? Should I hold on?
Yes, sir. So I want to ask the question. My question goes like this. How
Uh,
can you deal with customers that how can you deal with customers that are owing you credit and you still want to keep those customers with you?
okay. I think you would help me to allow me to. Okay, go ahead. Someone is talking again.
My German sir, so at this point before I want us to even see whether our team are even capable of access this small question, then we don't give all the wrong answer. So when come and answer the bad debt, as in come and answer this one. That we are managers, then German will not give all the everything about it. That's how you let's come and answer that one also.
Okay. Mr. Godwin, please tell her the questions, the ones you want her to answer, so that. But that's a very good idea. At least let's see how our managers can handle issues like this. Brilliant.
In terms of the good morning, sir.
Good morning,
In
ma'am.
terms of the depends on the company policy. Some organization they give out in like 2 to 3 weeks for the recovery of debt. But for our company, I would say we don't go with the policy. We are not stable on our policy, so that affects our sales returns in terms of customers refunding back their payment. So I would suggest if we can make a good stability of our policy in terms of bad debt recovery, like 2 to 3 weeks. So in terms of that, for the repayment.
That's a very good question. So what if, because we are not a bank, so when we are opening the account of those customers, we don't collect guarantor. We only just open for them and we start dealing with them in good faith. There's what we call in good faith in accounting and insurance. So we just go with them and dealing with them. So what if there is no guarantor? What happens in that situation? So that's another question that I also have on top of my head while she was talking. So yeah, HR.
Sorry, sir. As
Okay.
regards about the first of the policies that the company puts in, and you also have to check the credit worthiness of the customer before giving out credit facility. And for the best thing is I'm sure the best thing how if you check the credit facility, the best thing is that estates or properties that you can recover your debts, your money from if the person is dead. Maybe has properties down that you can collect money from. Is there an agreement towards that? There should be an agreement based on the policy.
So now, what all of this is saying, as in, because I don't want this training to be a waste of time. This issue of bad debt, that is, we gave loan to a customer and the customer is dead. It's already sending a signal to the sales manager that the way we give out credit is a wrong process. You remember the last time I discussed with you that before we give out credit, they should have a kind of a form that they would fill before we can even approve that let's give them credit. And I was saying that then we would have a guarantor, blah, blah, blah. Maybe you were the one I'm talking to, or I was talking to the MD on it. So what this is just sending as a signal to us is that the process at which we give out loan is not right. We are supposed to, even if it is a simple Google form, because somebody just said now that is there an agreement. Let me tell you point blank, you can't sell somebody asset to recover your money if you don't have an agreement to that effect. If they call it estate, they call it estate in accounting or finance. Someone's estate, the person might have collected loan from OPay or another bank, and that one has agreement. Those ones are the first person to go and run after that asset. So we will just go and queue at the door. Amamareti káwọn èèyàn sunkún tán ká lọ bá wọn pé ó jẹ́ àwa náà lówó. But àwọn tí ò bá ní àwọn tó bá ní collateral, they call it collateral security or debentures agreement. So it is only when you have a debentures agreement that you can lay hold on all the property assets. You lay a lien, we call it a lien, on their properties in finance. Ìyẹn ni pé agreement, an agreement yẹn gẹ́ máa lọ hold ní bank, and that's why I used to tell the HR, any agreement you have that is not quoted is not legal, is not binding. It's just a paper. So the summary is that when we give anybody loan and the person died, goods on credit, and the person died, tí o bá ti see proper documentation at the point of giving out that loan, my brothers and sisters, it is a bad debt in signal. It is a bad debt ló ti náwó already yẹn, because we may not be able. I remember there is one of our customers that died, and the husband called us. Abi Mrs. Adewale? And the husband called us and said, how much is she owing you? So that I can pay. That is, I want to ní ìbẹ̀rù Ọlọ́run nìyẹn. So it depends on the integrity of the person you are dealing with. But let me quickly just answer these questions so that we will not waste time on the assembly. But I like the idea that the HR said we should also allow some of the SMEs, that's the subject matter experts in our midst, to also attend to questions, which is a very good one. So the first thing is, bad debt is bad, and that is why it is called bad debt. The moment a debt cannot be recovered, it is a bad debt, and it is always treated as an expenses in the company's book of accounts. That's in our P&L account. The moment you declare a debt to be bad, then you treat it as an expenses. However, before you can do that, all effort might have been taken before you decided to say this debt is bad. And then part of those efforts is, they call it recovery efforts, has to be in line with the loan agreement at the time of disbursement. It is always advisable that you don't allow your debt to go bad. Instead of it allowing to go bad, you can sell your debt, and they call it debt factoring in finance. I will teach you later on that, because there are a lot of things in finance that we can't do in just 30 minutes call. So debt factoring is that you sell your debt to a debt collector. You tell them, Mr. Godwin is owing me 5,000. I know that you have an aggressive collector. Go after him. Collect my 5,000. After that, give me 3,000. You take 2,000. There are companies like that is all they do. And they will use all their means to collect that money from Mr. Godwin. The next thing you will start seeing your pictures in social media. You will start, and that is the approach. I want that fish shark and loan shark. They will start posting your picture to all your WhatsApp contacts. They will go and look after your name on Instagram, on Facebook, and they will be tagging you. So they will begin to make it an aggressive recovery. And you will be wondering like, wọ́n dẹ̀ pé wọ́n ní owó tó jẹ́ amúgòdù làwọn lé ẹ sí o, tó bá dá padà àwọn ò ní fi ẹ́ lẹ̀. Because they know that tán bá rówó yẹn gbà 2,000 lọ sọ́dọ̀ wọn, 3,000 bọ̀ wá lọ́dọ̀ wa, which is better than to write off the whole 5,000 as bad. So the 2,000 táwa fún ẹni tó bá wa recover, we will now treat that as recovering expense, not a bad debt. In our P&L, we call it profit and loss account, which is also called income statement account now, according to the new rules, the IFRS rule. So that is another approach. But the best thing is, don't allow a debt to go bad. But when you are giving out a debt, nígbà tá wà ní bank, wọ́n máa ń sọ fún wa pé at the time of giving out a debt, no matter the integrity of that customer, always have it at the back of your mind that nobody wants to pay back debt. So even tó bá jẹ́ pé ẹni yìí oníbẹ̀rù Ọlọ́run, always have it at the back of your mind that this debt, this person will not pay back. And that is why you would want to do anything that is relating to what if he didn't pay, what if he didn't do this, what if this happened. And that is why you would get all the guarantor. You will check that the guarantors have the capacity. You will also be very sure that there are collateral or there are assets to secure the loan, blah, 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 blah. But we don't do that because we felt like, and that is a big risk. It's a big financial risk. Someone mentioned, at what point should we stop giving credit? At a point when your credit exposure is taking 50% of your current asset, then stop. Then there is what we call single obligor limit in accounting and finance. Single obligor limit. Never allow a single obligor limit of up to 30 or 40%. What that means is that if 10 people are owing you 10 million, but one of that 10 people is owing you 5 million, and the remaining 9 is owing the remaining 5 million, it means that the single obligor limit is about 50%. That is, if that one person die, 50% of the money they are owing the company is gone. So don't allow your single obligor limit to be too high. That is, ẹnìkan ò gbọ́dọ̀ máa jẹ owó tó pọ̀ jù ní ara gbogbo owó tí company táwọn èèyàn jẹ company. And then don't allow your total debt, owó tán jẹ wá, to be up to 50% of your total current asset. And then maybe tomorrow or next, Mrs. Adeoye will teach us what are the components of a current asset, so that our class can now, our student can now, our staff can now understand what a current asset is and non-current asset. But tomorrow, she's going to talk to us about current asset. So when we sum up every item in current asset, the one that is debtor must not be up to 50%. To bá ti lè hit 50%, there is a big risk. In fact, some company will say our debtor should not be more than 5% of total current asset. So at any point, the asset wọ́n bá jẹ́ 100 million ní current asset, not fixed asset. There is fixed asset, which is now called non-current asset in accounting, and there is also current asset. So fixed asset ọ̀tọ̀ ni, another day, another person will teach us fixed asset. So current asset ìyẹn ní item tí èmi ní something. So màá fẹ́ kí Mrs. Adeoye wá kọ́ wa lọ́jọ́ mi. So tí owó yẹn, àwọn company mi á ní, if our current asset is 100 million, it must not be, people must not owe us more than 5% as debtor. 5% of 100 million, which means àwọn èèyàn ò gbọ́dọ̀ máa jẹ wájú 5 million lọ as gbèsè. Tí company yẹn bá ti ní policy yẹn, tí loan tán jẹ wá bá ti ń wọ 6 million, accountant tó wà ń bẹ̀ ó máa gba query, or the financial controller, because ó gbọ́dọ̀ ensure pé owó tán jẹ wá ò ju 5 million lọ, which is 5% of 100 million. So, but our company, we need to also look at how we can form a policy around that. And that's why Mrs. Tope said we should have a policy before we give out a loan or credit to person. Because ẹni tó wá jẹ wá ní 3 million naira, tó rajà láwìn ní 3 million naira lọ́wọ́ wa, tí that same person bá fẹ́ lọ sí microfinance bank tó bá fẹ́ gba 3 million, wọ́n lè ní kó lọ mú orí grandfather ẹ̀ tó ti kú wá àbí yẹ̀pẹ̀ bí tán sin bàbá ẹ̀ sí wá, kan tó fún ní 3 million. Gbogbo wa mọ̀ náà, tá bá fẹ́ yáwó ní bank, a mọ̀ bó ṣe máa gbogbo wàhálà tí wọ́n ní ká ṣe, ká tó ṣe, wọ́n ní ká gba BVN, NIN and the likes. But I'm good, we just give it out as if we are the one that is the younger brother of Emefiele or Cardoso. So please, we need to have a policy around our credit policy, and it's going to be very important if we can do that as a kind of a lesson to the company out of this class. Then somebody said, at what percentage should we give out loan to people? I think that has already been explained, Mrs. Promise. It's good that you give out credit as a way of to balance competition, but you have to also do it alongside with your policy. Don't say because our competitors are giving goods on credit, let us also give out goods on credit. You may shoot yourself on the leg if it is not an unwarranted credit. Unwarranted credit is because the competitor are giving out goods to your suppliers, to your own distributor on credit, and you now say because you want to do it, you want point, they want padà quote yín pé mi ò sọ fún yín pé mo fẹ́ gbà wín, ẹ̀yin lẹ tì sí mi lọ́rùn. Ẹ̀yin lẹ tì sí mi lọ́rùn o. Ẹ̀yin lẹ rọ́jà yín tà tẹ́ wá tì sí mi lọ́rùn. So if you must at any time also want to use credit giving as a means of competing, you should try as much as possible that you follow the 5 C's of credit. The 5 C's of credit: character, capacity. You look at all the 5 C's of credit and you follow it. Ṣé any character, show any capacity, show any this, show any that. I think our time is fast spent. Our time is fast spent. I need to submit at this point. GM, over to you, sir. Thank you everyone for listening, and do have an amazing day at work.